Yeah, now let's get into another new subject which is having a 5% weightage from our exam standpoint, slightly lesser weightage, so and slightly smaller as far as level 1 is concerned, but again, the weightage of it grows up in level 2. And one of the key securities which a CFA would be evaluating, along with the equities and fixed income. CFA's focus is also on the derivatives and all the other instruments like your alternate investment, mutual funds, commodities, private equities, or real estate. All these things they come under one single umbrella called alternate investments as far as CFA is concerned, whose weightage is much lesser in level 1 and not that big from level 2 and level 3 also. So it's just an overview of the other alternate investments you should be comfortable with. Whereas at least with equities, fixed incomes and derivatives, there is a lot of depth that you are going to cover. But level 1 focuses only on the different derivative instruments that are available. Why do we need to get into derivatives and what are these derivatives? That's the typical basic focus that is there as a part of level 1. So there are 6 chapters altogether. The first one focusing on the derivatives and the overview, why do we get into derivatives and something like that. And there are 4 different types of derivative instruments that are available. So one chapter for each of them, one for forwards, one for futures, one for swaps, one for options. So there are 4 chapters directed to 4 derivative instruments, and the final one is focusing more on how do you use these derivatives to do a risk management. So that's the entire composure of our derivatives subject. So the first one, see, as a simple thing, if I have to understand, apart from keeping the definitions and all aside, the simple way to understand the derivatives is I want to buy or sell something, not today, but sometime in future. Any buying or selling that happens at some future date, but with the price fixed today. So based on today's price, the real buying and selling happens sometime in future. That is what is a derivative instrument. Any instrument. So probably if you look at, it's like what you call the booking in advance kind of a scenario where I'll fix the price today, but the real deal will happen sometime in future. Now, what is the difference here? If the real on that day when the real deal is happening, the market price could be higher than the fixed price or lower than the fixed price. If it is higher, one party is getting a benefit. If it is lower, the other party is getting a benefit. Right? Because let's say we both are getting into an agreement that after 1 month, I will buy some article from you at 100 rupees a piece. That's a derivative agreement. Now, on that day, after 1 month, the price could be 105 or even 95. If it is 105, as a buyer, I have the benefit because I am buying it from you at 100. If it is at 95, as a seller, you have the benefit because you are selling it to me at 100, though the market price is 95. This is what is the funda behind the derivatives market. In a simple nutshell, any kind of a trade that happens not in the spot market, but sometime in the future kind of a market, but all the other attributes of that trade, the price, quantity, quality, everything is decided in advance. And sometimes it is viewed as a risk management kind of a tool. For example, a farmer and a middleman get into an agreement. Right? I will sell you all my product at 30 rupees a kg. And I will sell you some 500 kgs of this product after 2 months. The moment he is sowing the seeds, he will get into an agreement with the middleman, with some contractor, that he will sell all this thing at 30 rupees a kg to that person. Now, after 2 months, the price could even be 35 or 25 also. But still this guy is able to sell it at 30, which means from a farmer's perspective, one, he is having a kind of a guarantee that, yeah, at least I will get 30 rupees a kg. It may be 35, but still he is sure that at least his product is getting sold. So in some cases it is look like a risk mitigation kind of an instrument. In some cases it is used purely for a trading or a speculation kind of a purpose also. So whenever we are in simple terms, how do we differentiate the typical stock market from a derivatives market? The definition is very simple. For a trading in future, the price fixation happens today based on how the future price will be. Based on how you estimate the future price, we are fixing the current price. We are fixing the price as of today. It's not today's price. We both will get into an agreement at some price. That price is the price which I will pay you to buy something from you. You will sell the good to me at that price on that day. That's a typical agreement that happens in any derivatives contract. Now, derivative as such cannot exist in isolation. It's always some asset. Because we are buying or selling that asset not today but in future. But the price is of that asset. That asset could be a physical asset like commodities, agricultural commodities, or metals, gold, any of these things. Real estates, these are the physical commodities, physical assets. Or they could be financial assets, stocks, bonds, index, where there is no physical, tangible presence of those assets. Any of these things, foreign exchange, I can buy or sell these things not today but sometime in future, which means the price which we are fixing today is not in the air. It is based on the price which I am forecasting or which I am expecting that particular asset will move sometime in future. That's where we call it as derivative. It is deriving its value from the underlying asset itself. So there is no meaning of a derivative. Derivative is always derived from the value of some asset. It's just an agreement. Derivative is purely an agreement or a contract between the parties, that a buying or selling happens sometime in future. And today, let me tell you, derivatives market is the biggest market compared to any of the other financial trading instruments market. Right? That's the way. So some people are using it from a risk management standpoint. Some people are using it purely from a speculation standpoint. We'll see both the perspectives here. Now, then where are these derivatives traded? There are some kind of derivatives that are traded on the exchanges. There are specifically some kind of NSE deals with some derivatives. We have NCDEX dealing with some kind of derivatives, especially commodity based derivatives. NSE deals with stock based derivatives and the index based derivatives. Right? So different kinds of there are some kind of derivatives that are traded on the exchange itself, whereas some kind of derivatives are between two parties, which are typically called as your over the counter kind of derivatives. It's primarily through electronic dealer settled kind of transactions, which are the over the counter kind of trades, whereas the exchange based trades are which are happening on either NSE or any such kind of a physical marketplace in presence. And when we talk about exchange traded derivatives, they are fully centralized locations. There is an NSE, which is just like your stock market. The derivative instruments are also traded on the exchanges. I'll show you some of them so that you'll get some kind of clarity. And they are standardized and regulated. I cannot sell and buy anything and everything which I want. Because whenever there is a middleman, and the middleman is typically acting as a broker between the buyer and the seller, where he is buying from the seller and selling to the buyer. That is what is the typical role any exchange does. I buy from the seller and I sell to the buyer if I am an exchange. Now in that case, the exchange will only focus on those items for which there is a real market, for which it thinks there are buyers and sellers in good numbers, for which the trading takes place in large numbers, which means even if there are 20 different varieties of cotton, it will sell only two, it will trade for only two varieties of cotton. If I want a third variety of cotton, again it has to be between two different parties itself. Probably you just take the example of some vegetable market. There may be 20 different types of tomatoes available, but the most common tomatoes that are sold are only one or two varieties. Because those are the ones which are most frequently bought and most frequently sold. But if I want some special variety of tomatoes, I really need to check out for who is the seller and get into an agreement with that seller. Only some particular farmer will grow that kind of a tomato. So that is what happens even in case of the financial. So anything that is traded in a centralized marketplace, the items are more standardized and regulated. Whereas if it is I want, even in terms of quantity also, okay, one lot is 5 kgs of cotton. If I want 2.5 kgs, no, you buy it in the over the counter market itself, not on the exchange. Or if you want 7.2 kgs, no, either buy 5 or 10. So it's more standardized, right? And when I talk about over the counter, it's just between two parties. So you can set your terms and conditions. You can negotiate your terms and conditions. So it's completely customized kind of a contract. But the biggest problem is default risk is higher. Because we both got into an agreement. I'll buy something from you at 100. But if the market price is 95 on that day, I may feel like breaking your contract. Right? It's just between two parties. I like to break the contract. Same thing may happen from your side. If the price, as a seller, if the market price is 105, you may think, why should I sell to this guy at 100? I may sell it at 105. So the sense of default is higher in case of over the counter kind of contract, because it's an agreement between two parties and there is a good chance of breaking the agreement. Whereas when it is traded on an exchange takes enough measures. We'll talk about those things. Exchange takes enough measures to make sure that this default is very much minimized. Or even if the default happens, it can compensate the other party. So when we look at exchange traded derivatives, we find that the scope of default is much lesser compared to when we look at a over the counter kind of derivatives. And when we talk about the derivative transactions, these are the four varieties. We will talk about each of these things: forwards, futures, options, and swaps. So we see that forwards and swaps are purely over the counter, 100% over the counter only. Futures are 100% over the exchange. Options wise, you have both. Some very common options are over the exchange, and there is a world called exotic options, weird kind of options. That weird kind of options, they go over the counter. And out of these four instruments, options are more tricky. Right? We'll talk about them in detail, but options are the instrument which are slightly complex also in terms of understanding the structures, and they can be complicated to any extent. So that's the reason I'm talking about some exotic options or weird options. The world itself is called, that options world itself is called as exotic options world, which means some special, unique kind of options which can be created. If they are very special, obviously they cannot be traded on the exchange, they have to be traded over the counter itself. So those kind of options are over the counter, whereas the most common kind of options which are on the stocks or on the commodities, they are typically traded on the exchanges itself. Now, what is the difference between these four instruments? The first of it, which is the forward, is the one which we have discussed just some time back. An agreement to buy or sell something between two parties at a future date. So we both got into an agreement that I will buy something from you after 1 month at this particular price. This much quantity. All are set today itself. Quantity, price, quality, right, date. All these things are set today itself. But the real deal happens in the future on that date. So today there is no payment from my side to you or from your side to me. It's only an agreement. The real payment from me happens after 1 month. It's only, why is it being done? As a buyer, I may feel that the price will go up. So I want to lock the price today. Then you can say, why not buy it today itself? Every company has a cash flow cycle. Today it may not have the cash with it. It may get the cash after 1 month. Or if it buys today, probably it has to store it for 1 month. It may not want to incur the storage costs and all. So typically it wants to buy only after 1 month itself. But it is thinking that the price will go up after 1 month. Right? It is thinking, because future no one can give it with 100% accuracy. So it's just a prediction that the price will go up in future. So this company wants to lock the price. It doesn't want to buy at that price. It was based on the information it is able to get, or based on the way it has processed the information, it wants to lock in the price today. And that kind of price locking, it is getting into an agreement. It thinks that the price may go up to 105 rupees a unit. So let's try to get into an agreement that I will buy it at 101. Though the today's price is 100, probably it may say I will buy it after one month at 101. Now if the seller is also fine with it, because for seller also, today if he is selling, he has to sell it at 100. He may also, if he feels that, yeah, from a seller point, he may feel that the price will go down in future. Then a 101 looks like a better proposal from both the parties. Then immediately the deal gets into place. Right? So those kind of contracts are typically the forward contracts. Any contract which is making me buy or sell in future, but the decision of the price and the quality and the quantity are happening today itself. So there is no money movement today. Only after 1 month. Only the locking of the price, and probably from a seller's perspective, he is assured that his product will get sold. That's one way look at the forward. But because it's purely between two parties, there is a good chance of default that can occur from either of the parties, because on that day the price will not be exactly same as what we have entered into. So obviously there is the one party who is at an advantage, the other party is at a disadvantage. At least the parties are getting into an agreement based on the feeling what they are perceiving. This buyer is perceiving that the price will go up, so he is trying to enter into the agreement. The seller is perceiving that the price will go down, so he wants to block the price. Right? Then, because there is a good amount of risk involved, counterparty risk is what is called, because I'm making a payment but I may not receive the good, or the other party is defaulting. I'm ready to deliver the good to him but he is not ready to pay to me. Those are typically the counterparty related risk. Because that risk is high, the same transaction that happens over an exchange is what we call as a futures. The same transaction, buying and selling at a future date, price decided today, the same transaction that happens on an exchange. But the only difference here is you don't need to look out for your seller. If you are a buyer, exchange will be your seller. If you are a seller, exchange will be your buyer. So there is no need for searching for a counterparty here. If it is over the counter, I need to know who is my seller. Then only I will get into a buying, because it's always between two parties. Whereas on an exchange, the exchange will act as a counterparty. So there is no question of finding, the exchange will take the burden of finding the buyer for you or finding the seller for you. So at the first go, it will act as a seller if you are a buyer. It will act as a buyer if you are a seller. So because exchange is taking that risk, actually exchange is exposed to counterparty risk. Right? If you default, exchange is having a problem. Whether you are a buyer or a seller, if you default, exchange will have a problem. Obviously, exchange will not default. Right? That's one basic premise. At least in this years of history, there is no case that exchange has defaulted, at least. So exchange has to take enough care to make sure that the default is not happening, or even if you default, exchange is safe. Because exchange is taking this risk. It's acting as a seller if you are a buyer, it's acting as a buyer if you are a seller. Right? So it will, one way it minimizes that risk is, it will trade only in the most tradable kind of quantities. Some very unique kind of products it will not trade on the exchange. Right? Probably some oils, though there are so many types of oils available in the market, it will trade only in 2 or 3 varieties of oils, which it thinks are heavily tradable. There will be good number of buyers, good number of sellers. So the probability that one person will default is much, much lesser. So those kind of products only it will take up on the exchange. So that is what is the futures trading. The same concept, buying or selling sometime in future, but the price of it being decided today. But the only difference is the price is set by the exchange, not by the parties. What price you have to pay is set by the exchange, not by two parties. So it's not a customized kind of a contract. It's completely standardized, but the same concept. That's the futures. Then coming to swaps. So in that also, there is no cash flow today. Right? There is a small cash flow called margin, which we'll discuss about it slightly later. But between the parties, there is no payment on the day of entering of the contract. Only on the final day, the settlements actually happen. One party pays, the other party receives the goods. Then the third one is swaps. Swaps is also an over-the-counter instrument. Instead of one party paying the money and other party giving a commodity, right, selling a commodity, here both the parties get into exchange of the cash flows. Both do it in cash itself. Then what is the difference here? The agreement is like this. I'll pay you a fixed interest rate on some amount. You pay me a floating interest rate on that same amount for some period. So fixed interest rate is known, whereas floating interest rates keeps changing. So depending on whether the interest rates are going up or going down, the guy who is receiving the floating will receive different amounts, but when he has to pay a fixed amount. So sometimes that number he may be receiving more than what he is getting, sometimes he may be paying more than what he is receiving. So both the parties are exchanging cash only. This guy is paying some cash, which is that fixed interest. This guy is receiving some cash, which is floating interest. And what could happen because of this is there could be a netting that can happen. I have to pay you 50,000, but you have to pay me 60,000. So better you pay me 10,000, because both are in form of cash itself. or sometimes it could happen. That is called as interest rate swap. Two different interest rates we are swapping. Sometimes we'll call it as equity return swap. I'll pay you the returns on Infosys, you pay me the returns on Wipro. Without we actually having Infosys or Wipros,